Do you agree now that the Bank of England was wrong to say that immediately after the referendum the economy would slow sharply, it could even fall into recession?
No, I don't think I do agree. I mean, clearly the very short-term outlook for the economy since the vote has been brighter than many anticipated. But I think if you go back to what Mark Carney and in fact many other economists said when they talked about the impact of Brexit, they said there would be a hit over the next 12 to 18 months and even over the longer term, which would be on the order of 0.5 or 0.75 of a percentage point of GDP. Whether that puts you in recession depends on how fast you were growing in the first place. So I think the idea that I think is now often propagated, particularly in Westminster, that he was suggesting we were going to go over some immediate cliff, I think is unfair.
Except the implication was it was immediate. It would happen pretty well in the wake of the decision to leave.
He said there would be uncertainty and then there would be a hit to growth over 12 months. Although, now, I think we don't actually know yet. There is certainly some signs of weakness in the investment side, which you would have expected because that's on the sort of longer term. But it's absolutely right. And I think when the Governor of the Bank of England stands up in half an hour or so and starts explaining this new report, he will say that this last few months for growth and maybe the end of the year are looking better than they thought.
And actually they've been revised up.
These numbers have been revised up. The longer term forecasts have been revised down. They actually think the hit to growth, given the conversation around the change in the UK's trading relationship, given the fall in the pound, which is going to hit people's pockets and hurt consumer spending, is going to be larger than they thought a few months ago.
All right, well, let's put that to Melanie. Let's take the sort of time span that, they didn't get it right in the immediate aftermath, but in the long term, there are sort of weaknesses that seem to be showing now in the economy, and in the end, Mark Carney didn't get it wrong.
Well, he did get it wrong in the short term. And I think the fundamental thing he got wrong, and that many people who were prognosticating before Brexit and immediately after Brexit got wrong, is that this is a situation where you cannot forecast. It is unprecedented. There's never been a situation like this in which an economy of the size of Britain's does what it has done. And consequently, I just don't think anybody can tell what's going to happen. I do think that the British economy was talked down by the Bank of England and by the Treasury before Brexit. We were presented as being essentially weak, essentially supplicants, and this is simply, in my view, completely untrue.
Is that what the Bank of England was saying?
I think it's slightly odd, though, to sort of criticise the Bank of England for having tried to make forecasts, when actually it is part of their mandate that they have to set policy according to their estimates of what's going to happen to the economy and inflation. Now, goodness knows, they get their inflation forecast wrong all the time.
I mean, when was the last time they hit?
So do every other economist. But
Precisely.
to criticise them for having done a forecast which, on the basis of which they have to have in order to do
But Stephanie Flanders, how can we trust them to be accurate? I mean, I think the problem, as we know with all forecasting, but economic forecasting particularly, if you take Melanie's point that actually we are in unprecedented territory post-referendum in terms of the economy, why should we trust any of the forecasts that are given?
Unfortunately, they're in charge of this very crucial bit of macroeconomic policy, and I think we'd also say it was an abnegation of duty if they just threw up their hands and said, gosh, this is really hard, we're just going to wait and see what happens for the next few years, and then if there's a few pieces to pick up, we'll do that. I think we would ask them to err on the side of caution, knowing all of the uncertainties, and you've seen some of these very charts that the economics editor will always bring out, showing the very wide margin for error.
The fan chart.
The fan chart they bring out every year. So
what's it saying about inflation now?
Well, it's saying inflation is going to be going up to maybe 2.8 or around 3% by the beginning of 2018.
Right.
That's actually they're not saying it would go over 3%, but I think many people in the city.
What do you think?
Well, given what's happened to the pound, I think, and you think about what that does to import prices, I think it's quite possible that it will go over 3%. And I think we should be wary of the impact that will have on the economy when we are still very dependent on consumer spending, and that's hitting people in their pockets. Things are more expensive in the shops.
Right, and that would obviously hit consumers. I mean, actually, the National Institute of Economic and Social Research says that CPI, they think Consumer Price Index, will hit 4% next year, not even in 2018. Well, that would hurt people.
Yes, I think that obviously that is a shock to the system which may happen. I think there is, however, some concern that retailers are using this opportunity to sort of bump up profit margins and to take advantage of this uncertainty to pretend that the hit that they're taking is worse than it is. But nevertheless, I mean, I was a Brexiteer. And as far as I'm concerned, I always thought, and I never heard any Brexiteer say to the contrary, that there wouldn't be shocks to the system. It's clearly something as big as this is going to be ups and downs.
Right. What would you like to see the Chancellor do then, the autumn statement?
Well, I think that we have had an understanding, although there's been maybe unfair criticism of the Bank of England, even the Bank of England would say that monetary policy can only get you so far, and that you do need, especially if you're going to be trying to be flexible in response to a very uncertain, changing environment that we can't predict what's going to happen to the economy. I think the idea that he's going to give himself some flexibility to respond to that with more spending, yes, and maybe up front have a sort of insurance policy of more public investment going down the track of the next few years, I think sounds very sensible.
3 months ago, seems like 3 years ago, the bank predicted growth next year of 0.8%. It's now predicting growth of 1.4%. That's almost double what it said 3 months ago. Why?
Well, Andrew, you've been watching these forecasts for over the last few years. They always change a lot.
That's a big jump in 3 months.
I think it's actually, if you feed in what's happened this last few months and what's now quite likely to happen over the last few months of the year, there's just a sort of base effect which automatically then bumps up the growth forecast for next year. So I don't think they're suggesting that there's going to be some great momentum we're going to have going into next year. But the starting point, unarguably, is going to be better than they thought it was going to be.
And if it's predicting inflation is 2.7% by the end of next year and growth of 1.4%, can we take it that the interest rates will not be cut again?
I think if you don't have any change in the environment, if they don't have to change their forecasts again, it seems unlikely that they'd have a further cut, and that's what people in the city are no longer expecting that. But I think that they've said all along that they think the costs of easing too little are greater than the costs of easing too much. So you can expect them to be continuing to err on that side as we see this very uncertain thing unfold.
Stephanie Flanders, thank you.